Okay, good morning everyone. We are starting the webinar now. So today we'll give a quick results update on Kappa DC REIT and Solid Business Space REIT, followed by a company update on Q&M Dental Group. This is the disclaimer, please read it. So firstly for Kappa DC REIT, the title of the report we published last week is Acquisition of T27 is imminent. So T27 is one of the data centers that's inside the overall portfolio from the sponsor Capital TNT. This is the slide for Capital DC REIT. We have maintained our accumulate rating, target price 113. Our forecasted DPU for FY16 is 6.62 cents. This will give you about 6.3% dividend yield. Last close on Friday was $1.08. So here I'd like to take some time to explain this about why first quarter 15 is prorated. So the REIT was IPO'd in December 2014. So the first quarter of 2015, the results was slightly longer than 3 months. It included some days in December 2014. So in order to make the results comparable, the first quarter 2015 numbers are prorated. So moving on, let's take a look at the results. So gross revenue was lower by 4.5%, mainly due to the client downsizing in Citadel 100 and the depreciation of the Australian dollar and Malaysian ringgit against Singapore dollar. Citadel 100 is one of their data centers that's located in Ireland, and the lower gross revenue was offset by contribution from IC2. This is the data center in Australia that was acquired in the second half of 2015. So this would contribute positively to year-on-year gross revenue growth for at least the next 2 quarters, meaning second quarter FY16 and third quarter FY16. Net property income was lower by 2.5%. There was some lower property-related costs, but depreciation of Australian dollars versus Singapore dollar dragged down the performance for NPI. Distributable income, there was a 3.8% increase year-on-year. This was mainly due to the realized gain on settlement of foreign exchange foreign contracts and higher finance income. And so bottom line, DPU was 1.67 cents, which is 3.7% higher year-on-year. One thing to note is that Capital DC pays their dividend on a half-yearly basis. So this, although there's a 1.69% DPU, but this isn't declared yet for distribution. So now the 4 bullet points we have. So negotiations are ongoing to raise occupancy at Citadel 100. So the occupancy at Citadel 100 is now about 53%. This compared to 77% a quarter ago. This is due to one of the tenants there downsizing, and the manager is actively in negotiations with few prospective tenants, and the manager expects them to take up the bulk of the remaining space at Citadel 100. The other thing is work at Minicube's data center has commenced. This is the forward purchase agreement that they went into for the data center in Germany. Currently, they have cleared the land and it's ready for construction. They're just waiting for the building permit from the authorities for them to commence the actual building of the property. For there will not, the next bullet point, there will be no material changes to the REIT with the transfer of the manager under PhillipCapital. So as you have read already, there will be a consolidation of Capital Corp's interest in asset management and private equity. This will be parked under PhillipCapital, but there will be no changes to the REIT. The manager will still remain the same. Sponsor also will remain the same, Capital T&T. Lastly, acquisition of T27. So as the title said already, acquisition of T27 is imminent. You may have read also that Capital T&T has announced that this property is already fully committed. So Capital DC REIT is already in negotiations to acquire this data center, and the acquisition will be done either in the second quarter or third quarter of this year. The other thing is that it's quite likely there will be some equity fund raising, as the manager wants to keep the portfolio gearing at 30%. The gearing for the portfolio currently is at 29.6%. Okay. Moving on for solid REIT. Okay, so we also maintain our accumulate rating on solid REIT. Target price slightly lower, is 83 cents now, down from previous 86 cents. We're forecasting a DPU of 6.16 cents. This will give you an 8.7% yield. The last close on Friday was 74.5 cents. So looking at the results, gross revenue grew 8.2%. This was mainly due to high rental from Technics. You can see it's 2 million. It contributed 2 million extra GRI for the quarter. Technics is quite a fairly large property relative to their portfolio, and this was acquired in May 2015. So there was also lower revenue coming from Tuas Connection and West Park East Central, where these two properties had slightly lower occupancy quarter on quarter, and consequently as well year on year. Net property income higher by 8.8% year on year. Distributable income was in line with the higher NPI, and lastly DPU was down 4.7% to 1.557 cents. This was due to the larger unit base, where in 1Q15 there was about 816 million units, and now there's a 938 million units. We'll talk a bit more about how they fared in terms of their renewals and their new leases, and as well as for renewals. So for their renewals, they managed a 6.6% positive rental reversion, but this was mainly attributable to only one tenant. The rest of the tenants, there were a total of 7 leases that were renewed. Of the 7, most of them came from West Park East Central, where the revisions were flat. There was only one tenant which was, sorry, the 6.6% positive reversion was mainly attributable to one tenant at Tuas Connection. How this came about is because this tenant's lease was first signed 5 years ago, when the rent was much lower compared to today, and that's how they could get the positive rental reversion. Talk about the new leases. Okay, so the manager also managed to secure 2 new leases. We believe this was at Tuas Connection. And now we'll move on to forward renewals. So forward renewals was flat at negative 0.6. So you can say it's a negative 0.6 rental reversion. There were 2 of them, one each at Tuas Connection and Atrium. So the manager guided that they had to give some rent incentive in exchange for the certainty of the forward lease. Lastly, we talk a little bit about their exposure to marine offshore and oil and gas tenants. So yes, their portfolio does have a material exposure to these tenants from these sectors. Uh, as a percentage of portfolio gross rental income, marine and offshore accounts for 11.2%, while oil and gas is 12.3%. So collectively, these two groups, marine, offshore, and oil and gas, they account for 23.5% of the portfolio GRI. However, the tenant exposure is actually diversified across 7 properties, and of the 23.5% that I mentioned, 17% are actually from master leases. So this is actually quite stable, and the remaining are from multi-tenanted properties. So all the master leases are on long leases between 7 to 15 years, and the first master lease will only expire in 2020. One of the master lease, which is Solaris, but that's an underlying sub-lessee. That one will the master lease for Solaris will expire in 2018. So the risk from marine, offshore, and oil and gas tenants actually is quite diversified across properties and across the different type of leases. And also the REIT is actually has managed this risk quite well, in the sense that they have mitigated the risk of arrears. For master leases, they have 12 to 18 months rental deposit, and for the multi-tenanted buildings, they collect 3 to 5 month rental deposit. This not necessarily will be collected in cash, but they will have a banker's guarantee, which they can draw upon if the tenant falls into arrears. Okay, so I've come to the end of this portion. I'll hand it over to Lindsay, who will talk about Q&M Dental Group.
Hello, good morning everyone. This is Lindsay, your consumer and healthcare analyst. So I am pretty sure that everyone is quite familiar with Q&M Dental, and it has been quite a while since our last update. So today I'll just bring you guys through what are the recent developments for Q&M. Okay, just to show you a snapshot of a brief overview of how Q&M has been faring for the past 1 year. So the green line shows STI index, and for the past 1 year, it has been overperforming the STI index. So it closed at 68 cents on Friday, and we have revised downwards our target price to 70 cents, and we downgraded our rating to neutral. So just a brief update on why we are still quite positive on these stocks. So because the investment thesis remains intact, there's still a favorable demographics trend, as you can see from this chart here. The blue line is the population trend, still moving up, it's still trending up. As for dental services, as you know, that it's a very niche and resilient business, where you can see from this chart below here, the orange line represents the annual growth of outpatient attendance to dental clinics. You can see that it's actually trending upwards as compared to the blue line here, which is the population growth. From the chart itself, you can see there's some peaks and dips on the outpatient attendance. It's mostly not, the dips mostly are not due to the economic downturns. It's more due to the disease outbreak in Singapore, where Singaporeans will refrain from going into healthcare facilities like clinics, hospitals. As you can see from here, especially referring to the 2003 case where SARS outbreak happened. You can see there's a dip here, and there was also a dip here in 2009 where there's a H1N1 outbreak as well. Thirdly, we see that healthcare as a whole generally still benefits from government subsidies, especially from the community health assist scheme. So there will be lower out-of-pocket expense coming out from the patients or from Singaporeans in general. This is just a price chart extracted from the company website. Then there's also a low dentist to population ratio compared to the developed markets. So according to the group, the dentist to population ratio in developed markets is 1 to 1,000. As that compared to Singapore of 1 to 3,000, to Malaysia's 1 to 6,000, and to China's 1 to 10,000. So as you can see that in China, there's still much room to grow. And why Q&M? Because Q&M has a very strong foothold in Singapore and is expanding in China, especially in the northeast region. Sorry. So this is a table on Singapore's on Q&M's expansion, comparing 2015 to 2014. And we also see there's a growing demand for its China manufacturing business. So from the profit guarantee itself, where it's expected to grow at an annual pace of 15% year on year, that compared to the normal clinic profit in Singapore, which would average grow by 5 to 10% year on year. So as you can see that there's a superior growth rate in their manufacturing business in China side. And we also favor its strategic M&A plan, where it expands its dentist pool by acquiring clinics. This also enables flexibility in working. For example, if a dentist from an outlet would like to take off, and it will be replaced by some other dentist from the group, hence reducing downtime of a particular dental outlet. It's also expanding, and also they are sharing a customer base across the island. There's also opportunities for dentists to enhance their skill sets. In particular, that the specialists would be giving trainings to the GPs, the general practitioner. They would also be able to introduce new technologies to some clinics which do not have such funds or capital to acquire these new technologies. There's also a vertical integration, where for Q&M Group, they had manufacturing business. They cover from manufacturing business to the distribution side, as well as to the face-to-face client healthcare services. Then last but not least, they most of their M&A acquisition deals comes together with a profit target or guarantee. This actually provides a long-term profit visibility. Usually it will range about from 5 to 6 years all the way to 10 years. So yeah, it provides quite a long-term profit visibility in this sense. Okay, to give you guys their recent development. So number one would be on the impending spin-off listing of iDeter. So the management shared that to enhance the long-term shareholder value, they are going to list it in the new third board, the OTC market in Shanghai. So for this point, I will elaborate further in the next slide. So in the latest update is that in November last year, SGX has already given their blessings. So this is just a pro and cons analysis of the spin-off listing of IDT. So what's there to lose? Okay, firstly will be on the material dilution of the group's equity interests in IDT. It will be reduced from 100% to 51%. Although that we see that there is a huge decrease, but bear in mind that at the moment, Q&M only recognizes 51% of its financial revenues generated from IDT because they took into account of the 49% options granted to its two founders or directors of IDT. Hence, from that structure-wise, we don't see much changes there. But there's a downside risk to it where post-listing, the group might not be purchasing as much as 51% equity interest in IDT. However, they also shared that they are going to remain as a substantial shareholders of at least 30% of IDT's equity interest. Secondly, there will be changes to the non-compete and potential loss of profit guarantee. As mentioned earlier, IDT is actually growing faster than its Singapore clinics business. Is contributing about 37% of the group's profit before tax in 2015. That compared to in 2014, they contributed about 25%. So if successfully listed in the new third board, the profit guarantee for the next 10 years, which amounts to about 142 million renminbi, will be forfeited. However, the management shared that they have yet to come to an agreement with IDT, and they are still in the midst of finalizing the terms and conditions. So we have yet to know what would be the method of how IDT would IDT's revenue will flow down to Q&M. Okay, what's there to gain? So firstly would be on that by listing off IDT, IDT would have its own channel from the China markets to fund its expansion. So giving its capital intensive business, when it has its own channel of funding, this would surely free off Q&M, where Q&M can utilize these funds to expand on its core business or even to acquire into other areas where it could bring higher returns on investment for its shareholders as compared to this manufacturing business. Secondly, on the potential incentives and compelling offers by the Chinese authorities. So in this sense, by listing off in the new third board is of lower listing costs, and also the IDT will be able to enjoy policy incentives and government subsidies. There's also a lower government intervention in the new third board, where there's no requirement for companies to be profitable prior to listing. There's also no limits on the amount of the shares can move in one day. Thirdly, there might be potential special dividend coming from this restructuring exercise as well as spinning off. If you refer to my report, I've actually came up with a case analysis on by different range of PE multiples that IDT will be able to spin off at, how much investment gain they will be able obtained. Nonetheless, there's a higher chance where Q&M would issue new shares to editor rather than using the cash proceeds from the listing off to purchase editor's shares. And we also think that Q&M is more likely to retain the proceeds to fund its own expansion rather than paying it off to shareholders. Last but not least, the group is also looking to spin off Q&M Dental Holdings China, its healthcare services in Shenyang separately after editor's listing. Okay, this is just to give you a feel of or a gauge of the possibility of the PE multiples that you will be able to obtain after if successfully listed in China's market. And that actually compared to its visual peers is actually much higher. And not forgetting that editor was actually acquired at a very low PE in August 2014. Okay, the second updates would be on its M&A deals. As you can see from here, most of the deals are actually done within the year of its announcement. The deal on Orchard Scotts Dental is still pending because the management shared that they are still renegotiating for better terms with the management from Orchard Scotts. Actually, it's not peculiar for that. The group will go under renegotiation for better terms. For example, for TP Dental and Aesthetic Dental, initially the announcement was the deal will be based on profit target, but upon acquisition, they renegotiated into and converted into a profit guarantee. So we think that Orchard Scotts Dental deal should be able to complete by this year with better terms. From the timeline itself, is actually a testimony to the group's commitment and effectiveness in delivering what was announced. So what's next for Q&M? For the Singapore side, we think that it's going to slow down by growing organically because we think that the market is rather saturated, but we think that it's going to continue its blow-up strategy where it would either acquire some add-ons services, or they are going to venture further into the premium markets. So you will be able to corner both markets from mid-range to the premium high-end range. Just an update on its recent organic growth. We just opened a new clinic in Bishan in March. As for China, we think that China would be the main focus for the group. So we expect that the group would kick up its gear to grow its business in China, particularly in the northeast region in the Liaoning province. So it's currently looking into acquiring a medical equipment distribution company. So with this move, it will be able to set up a distribution center in China side as well, hence giving it a competitive advantage by having a distribution center in all the three countries which it operates in Singapore, Malaysia, as well as China side. As for Malaysia, the management shares that they are cautious but remains vested in the market. As you can see that from the earlier table, they actually has announced a deal on Smile Bay Dental in Penang in mid of last year, in fact. But it has yet to close because of the higher political as well as FX risk. They are still monitoring, and the deal is still under review. Okay, last but not least, I'll just bring you guys through how the company has fared last year in financials perspective. So for the clinic side, we can see that there's a 16% higher revenue. This is mainly contributed from the existing as well as the new clinics in both Singapore as well as China side. The Malaysia side is performing well. It's just that they are being hit by the foreign exchange. As for the manufacturing end, as you can see that it actually grew more than doubled last year. This is because that 2015 is the first full year contribution recorded by Editor. Editor was acquired in August 2014. So this only reflects a half a year contribution. Just to highlight a bit on their segmental gross margin. The clinic gross margin actually improved slightly. This is due to better margins coming off from its clinics, China clinics. As for its manufacturing business, it's still remaining above 60%. Geographical wise as well as segment wise, you can see that the China side and especially in particularly its manufacturing section is taking up a higher portion, becoming more important to the group's revenue top line. And we expect that it should continue to grow. Last but not least, just to touch a bit on the employee costs. So in 2015, employee costs increased. This is mainly due to the higher costs coming from the premium clinics, the acquisition of the premium clinics in 2015. However, the salary as a percentage of total revenue actually decreased to 51% from 54%. So there's we can actually see some form of operating efficiencies coming from there. Okay, coming to peer comparison and valuation wise, we have rolled over the balances into our new financial year. We have adjusted the number of clinics, revised downwards our FY16 earnings by 40% due to the challenging business environment in the countries the group operates in. We have also reset the forward P multiples to 38 times. This is actually a slight premium compared to its Asian peers. And that also at 38 times is actually a slight within this range of average historical PE to -1 standard deviation. So what are the potential catalysts for re-rating? For the near term wise, it will be mainly looking into how aggressive that they are going to acquire on their M&A deals. How are they going to integrate across the border, and also what are the PE multiples that they will be able to list Editor, and what are the terms and conditions on the listing, not just on Editor but also on the Shenyang Hospital's business as well. So let's stay tuned and look forward towards its listing deals. As for the investment risks, as everyone knows that, and also as mentioned earlier, it will be on the market situation in the dental market situations in Singapore as well as in China side. So there is a growing competition, especially in Singapore. Margin compression, mainly due to the higher labor costs, significant regulatory changes, execution risks, and also difficulties in maintaining their dentists and staff. So to conclude, we have revised downwards our target price to 70 cents as well as our rating to neutral. With that, I would like to open the floor to any questions. Thank you.
Hello, this is Richard speaking. There's a question, what is the NAV for soybean wheat? Yeah, the NAV for soybean wheat is 79 cents.
Hi, there's a question on Q&M. So first, what's the forecast for Singapore dental segment and China respectively? So for Singapore side, we are actually forecasting that it would at least acquire probably 5 outlets as per usual. For the past, as per its historical, as per his its historical M&A deals, about 5 outlets. And as for its China side, we're actually giving a higher growth rates, not just from the hospital sides, but also for the manufacturing side. The second questions would be on effect of IDTA spin-off on income statement. Will the spin-off reduce revenue contribution for supply segment and how much? As for this, we actually at the moment, IDTA has been contributing much more compared to its profit guarantee. It's growing at a higher rate as per what was expected as 15%. That's the same for 2014 and 2015. So by listing off editor, there might be a risk of getting lower than what was promised in the profit guarantee, but it also opens up the upside risk where it's getting a higher expansion, given that by listing it off, it would gain access to a higher capital where it can expand more aggressively as compared to now, where its only funding source is from Q&M. But at the moment, we are still unsure of how the terms and condition book will be finalized. So I can't really comment on what would be the final impact on its income statement. As for the third question, will be any timeline for editor spin-off. As you know that there is a okay, they have already obtained blessings from XGX as well as from its shareholders, and they are in the process of listing it. And I have no idea how efficient the Chinese authorities would be for the new top board, but as we know that for the main board in China, usually it will take more than it will take a longer time in that sense. When we refer to the precedent case, but for this, we are actually hoping that probably by end of the year, or by by end of the year, since the new third board doesn't really requires any profit requirement prior to listing. If there's no other questions, we shall end our webinar. Thank you for tuning in, and hope to see you again next week. Thank you.